the nation's largest investment in infrastructure in a generation.
It's our job to give our people that chance.
Law was just passed that impacts your crypto holdings, but there's a whole lot of confusion around this bill and what it actually means for both beginner and advanced crypto investors. The law that was just passed is the new $1 trillion infrastructure bill. I never understand why they give presidents such small desks when they sign these things. Either way, we have two things going for ourselves here. First, I have personally read hundreds of pages of this 2,700-page bill and even broke the spending down into 13 easy-to-read graphs. And second, I'm a bit of a dork when it comes to this stuff, and I have experience in digesting these bills into words that can actually be understood in English. So let's briefly cover this bill, how it impacts your crypto, and a dramatic change we may see in the future. Taking a glance at this bill is like standing at the bottom of Mount Everest looking up thinking, like, I'm never going to conquer this thing. It's an absolute beast. But then you start nibbling away and it just becomes easier and easier. So at the top level, we can see this $1 trillion bill is intended to give the United States a much needed infrastructure facelift with some crypto shenanigans sprinkled on top. It has completely passed after many delays and is now set in law. I've broken down this bill into two parts: new funding and existing funding. About half the bill is simply continuing funding on existing projects. The other half is new spending and new laws. Now let's quickly break this down further, and feel free to pause this if you want to look at the further details. First, we have roads, bridges, and major projects, $110 billion in funding. Railway infrastructure, $66 billion in funding. Public transit, $39 billion in funding. Safety and research, $10.5 billion. Airports, $25 billion. School bus and ferry emissions, $7.5 billion. Well, reading through this bill, I could not believe how often ferries were mentioned. 42 times, I counted. It's a good time to be in the ferry business, I guess. Next up is ports and waterways, $17 billion. Broadband internet infrastructure, $66 billion. Power and grid funding, $73 billion. Water infrastructure, $55 billion. Resiliency, $46 billion. Now you might be thinking, I didn't see crypto infrastructure in there or digital assets infrastructure. What does ports and waterways have to do with digital assets? Crypto fits in because they plan to collect additional taxes from crypto in order to pay for a portion of this bill. That's how it fits in. A small portion of the bill, that is. Now, hidden away on page 2,433 are new laws for crypto regulations within this infrastructure bill. So first, we're going to look at the definition of digital asset, which is right here. Digital asset means any digital representation of value which is recorded on a cryptographically secured distributed ledger or any similar technology. Now we need to scroll up here and look at brokers, because this is one of the major issues here in the reporting of digital assets. So brokers, the definition of brokers is in another law. So this is something that happens a lot in legislative text. They just refer to other ones. So it's like impossible to read and you have to pull up other bills. So here we have the law that says what brokers are and what they should do. And one major thing that they should do is show the name and address of each customer. If we scroll down a little bit here to the definitions, one of them is any other person who regularly acts as a middleman with respect to property or services. Now, in this instance, a broker is very loosely defined in the case of crypto. This could encompass stake pool operators, miners, and a ton of other crypto services that could technically be considered brokers. So if we scroll down further here, we can see what brokers are required to report to the IRS. We have to scroll way down here. And one of them is a specified security in this section B. So if we go back to the bill text here, it says that they need to strike out a section of the bill text and add in any digital asset within this definition of a specified security, which means any broker, which is given a large definition here, has to report these specified assets, which now encompasses any digital asset. And then this brings us to the second issue. Don't worry, I'm going to summarize all this. The second issue is the reporting. So reporting here, we can see any broker, which we know this is a loose definition now, with respect to any transfer during a calendar year shall make a return for that year. Now, these words in between that make no sense. This basically says any broker who processed a transfer in a calendar year of a digital asset, which was defined earlier, will need to report it to the IRS, and they need to treat that transfer as they would treat cash. The treatment as cash for the purposes of section 6051D. Now, if we look at the text for that, this basically says any transfer of more than $10,000 needs to be reported to the IRS. So to summarize this, there's a few issues within this bill text that people absolutely do not like, and for good reason. First, the loose definition of broker that can encompass a miner, a stake pool operator, certain DeFi operators. Second, the KYC requirements for nearly anything having to do with crypto. And third, reporting requirements that are very similar to cash. Now, if you're a normal crypto buyer who pays their taxes, will this law impact you? In some situations, yes. In other situations, no, not really. So let's do a couple examples to highlight this. Example human A is Brenda. Brenda uses a regulated exchange, Coinbase, to buy her crypto, and she uses another regulated service called BlockFi to earn interest on her crypto. Brenda says that you should use the link in the description for BlockFi because you can get a pretty darn good yield on your crypto by creating an account, and you'll earn up to $250 in free Bitcoin by making that account and transferring some funds in. But seriously, nothing is going to change for Brenda using those two services. And this is because Coinbase and BlockFi are both already regulated exchanges. And all regulated exchanges already send what's called a 1099-B to the IRS. This document essentially tells the IRS what gains Brenda had this year. And then we have example human B, Klaus. Klaus is your average German Innovation Award winner who also happens to be an advanced crypto user. He uses Binance, a regulated exchange, to exchange his fiat dollars into crypto, but then he uses that money to buy altcoins on PancakeSwap, he yield farms, and he flips NFTs. He kind of does it all. And this is all perfectly legal. However, DeFi services typically don't do KYC, meaning they can't send that gain and loss report to the IRS because they don't exactly know who you are. They don't have your social security number. So here's what happens. Let's say Klaus, he initially deposited $1,000 into Binance, and then he flipped, traded, and yield farmed his way up to $10,000. And then he went ahead and transferred that money back into Binance and transferred that into his bank account. The issue is Binance has no record of transactions. They just see that $1,000 turning into $10,000, when in fact there are expenses like gas fees, transaction fees, and potentially both short and long-term capital gains all within that $10,000, taxed at different rates. But Binance doesn't know that. It's a complete mess. What this means for Klaus is he now needs to keep meticulous record for all transactions and all fees if he wants to make sure that he's not overpaying on tax. In the past, many people have just simply skirted this requirement by not reporting the gains. But the new laws require larger obligation for services to report on behalf of users. And I'm actually working on a free crypto tax calculator that I hope to give away in the next few weeks. So just make sure you subscribe so you can grab one of those once I'm done with it. It's just taking much longer than expected. Now, there is one change that we may see in the future to this law. This is because of how broadly the law is written as to who is considered a crypto broker. There are two things that we should consider here. First is what the Treasury said about this debacle before the bill was even passed. The Treasury has reportedly said that it will continue clarifying guidance after the bill is passed to provide exemptions to firms that do not actually operate as brokers. This means the Treasury intends to clean up definitions of people who aren't exactly brokers. Now, this is fairly common in legislative text. A law will be made, however, it's up to an individual agency to come up with specific guidelines. I saw this personally with small business stimulus programs. Money was allocated to help small businesses, but the SBA then had some discretion as to building out the finer rules of individual programs. And second, there is already an amendment in place to help tweak the law for those who don't trust the Treasury will do the right thing. This amendment hasn't been passed yet, but it would exclude the following services from falling under the broker definition, this broad definition that we're having an issue with. First, those who validate distributed ledger transactions. This means miners and stake pool operators would be exempt. Second, those who sell hardware or software used to store crypto. And third, those who develop digital assets. And there you have it, the best darn bill breakdown on the internet. Checkmate, Bloomberg. If you appreciate my research, go ahead and hit that subscribe button. I would appreciate it so very much. And if you want to take this relationship to the next level, check out my Patreon for the best darn deal on the internet, including my buy alerts, my thoughts on the market, a private community, some hot memes, and much, much more. So I'd like to thank you so much for watching, and I hope you have a profitable day.